Imagine you spend 40 years of your life grinding. You wake up early, you skip the expensive vacations, and you diligently put money into your 401k every single month. You do everything right. But on the day you retire, a stranger walks up to you and hands you a bill for $323,000. You never signed a contract for this. You never saw an invoice. But the money is gone anyway. This isn't a hypothetical nightmare. It is the mathematical reality for millions of Americans currently invested in target date funds. We have been sold a story of convenience that is quietly cannibalizing our retirement. Today, I am going to show you exactly how to find this hidden tax, why the financial industry relies on your laziness, and how 1 hour of work a year can reclaim that lost fortune. I have spent the last week digging through prospectuses and running compound interest models. And what I've found is honestly a bit offensive. We call it the target date fund tax. It is the price we pay for the set it and forget it lifestyle. Now, before we dismantle this system, I want to make sure you get the best return on your time today. If you find this breakdown helpful, consider subscribing. I don't sell courses or proprietary software. I just like doing the math so you don't have to. For those of you who want to go deeper, we have a community called the Optimizers. You can click the join button to get priority replies and help me keep these deep dives ad-free. But first, we need to look at the year 2006, because that is when the trap was officially set by the United States Congress. Back in 2006, Congress passed the Pension Protection Act. On paper, it was a huge win. They realised that most employees were either too intimidated to pick their own investments, or they were just leaving their money in a cash account earning 0%. To fix this, they allowed employers to automatically enrol workers into something called a qualified default investment alternative. Essentially, if you didn't pick where your money went, your boss could pick for you. Almost overnight, the target date fund became the undisputed king of the 401k. It was marketed as the ultimate solution for the average person. You just pick the year you want to stop working, say 2055, and the fund does the rest. It buys the stocks, it buys the bonds, and it promises to manage your risk as you get older. It solved the problem of inertia, but in the process, it created a massive, invisible revenue stream for the world's biggest investment firms. They realized that once you're in a default fund, you almost never leave. To understand the cost, you have to understand the engine. Every target date fund runs on something called a glide path. Think of it like an airplane coming in for a landing. When you are young and retirement is far away, the plane is at high altitude. The fund is aggressive, putting 90% of your money into stocks to capture growth. As you get closer to your target date, the glide path automatically tilts the nose down. It sells stocks and buys bonds to protect what you've earned. Some funds land the plane exactly on your retirement year, while others, called through funds, keep adjusting for 15 years after you retire. It sounds sophisticated, right? Like you have a personal pilot managing your wealth. But here is the secret. That pilot is an algorithm. A very simple one. And yet, the financial industry is charging you like they've got a team of experts hand-picking every single stock in the cockpit. They've turned a simple math formula into a premium service. If the glide path is the engine, the fund structure is the body of the plane. Most target date funds are what we call a fund of funds. When you buy a share of a 2060 fund, you aren't actually buying stocks. You're buying a wrapper. Inside that wrapper, the manager is buying other mutual funds. They might have a large cap fund, an international fund, and a bond fund tucked inside. This is where the fee layering gets sneaky. In the old days, they used to double dip. They'd charge you a fee for the target date wrapper, and then you'd pay the fees for every fund inside the wrapper. While regulators have mostly stopped the most egregious double dipping, the structure still allows firms to pack your 401k with their own expensive actively managed funds. It's like a restaurant that forces you to buy a bundle of appetizers you didn't want just to get the main course. You are paying for the packaging, not just the contents. There is a massive divide in the target date world that most people completely miss. On one side, you have passive funds. These are built using low-cost index funds that just track the market. On the other side, you have active funds. These are the ones where human stock pickers are trying to beat the market. Morningstar data shows that active funds carry much higher expense ratios. The kicker? Over a 20 or 30-year period, nearly 90% of these active managers fail to beat the basic market index. So, not only are you paying a premium for a human to manage the fund, but that human is statistically likely to give you a worse return than a simple computer script. Many employers, because they have deep relationships with specific financial institutions, default their employees into these expensive active funds without a second thought. They aren't looking at your bottom line, they're looking at their own administrative convenience. We're about to look at the hard math of what this costs you, and it's uglier than you think. Before we keep going, I need you to realize something. If you think a 1% fee sounds small, you are falling for the oldest trick in the book. A 1% fee doesn't mean you lose 1% of your profit. It means the fund manager takes 1% of your entire balance every single year forever. Whether the market goes up or down, they get paid. If the market returns 8% and you pay 1% in fees, you didn't just lose 1%, you gave away 12.5% of your growth for that year. But when you factor in the lost compounding interest over 40 years, that 1% fee can actually wipe out half of your potential wealth. Half. If that sounds impossible, stick with me. I've run the numbers for a hypothetical investor named Sarah, and the results are honestly life-changing. Human brains are not wired to understand compounding interest. We're even worse at perceiving the danger of small percentages. If you saw a store charging a 1% entrance fee on your total net worth just to walk in the door, you would scream and walk away. But because the expense ratio is deducted automatically from your fund's returns, it remains invisible. You never write a check for it. You never see it on a credit card statement. It's just a tiny drag on the daily price of the fund. John Bogle, the legendary founder of Vanguard, called this the tyranny of compounding costs. He pointed out that while returns compound in your favor, costs compound against you. Over a long career, the financial industry is essentially skimming the cream off the top of your milk every single morning. By the time you reach retirement, you're left with a glass of water while they have a bucket of cream. Let's look at the actual math of how Sarah lost $300,000 without ever knowing it. Every dollar you pay in fees is a dollar that isn't working for you. If you pay $10 in fees today, it doesn't just cost you $10. It costs you the growth that $10 would have earned over the next few decades. At an 8% return, that $10 would have turned into nearly $150 over 40 years. When you multiply that by thousands of dollars in fees every year, you start to see why the numbers get so big. Most people look at their 401k statement and see a balance of $100,000 and feel great. They don't see the ghost balance, the money they would have had if the fees were lower. That ghost balance is what we're hunting for today. I want you to start thinking of every basis point in your expense ratio as a leak in your retirement bucket. It might look like a drip, but it's actually a flood. Let's meet Sarah. She's 25 years old, she just landed a good job, and she has $10,000 to start her retirement journey. She decides to contribute $500 a month. Her employer defaults her into a proprietary target date fund. This fund has an expense ratio of 0.75%. Now, 0.75% is very common in the corporate world, especially in smaller companies. On paper, her gross return is 8%, but after the fee, she's netting 7.25%. After 10 years, Sarah has over $100,000. After 30 years, she has almost $700,000. By age 65, she retires with $1.49 million. Sarah is thrilled. She's a millionaire. She thinks the target date fund was a great deal. She thinks the convenience was worth it. But what Sarah doesn't see is the parallel universe where she took 20 minutes to change 3 settings in her account. In that universe, she isn't just a millionaire. She's significantly wealthier. Now, let's look at scenario B. Same Sarah, same contributions, same 8% market return. But this time, Sarah opts out of the target date fund. She spends 1 hour learning how to build a 3-fund portfolio using the low-cost index funds already available in her plan. Her new blended expense ratio is 0.05%. That is 15 times cheaper than the target date fund. Her net return is now 7.95%. After 10 years, the difference looks small, only about $5,000. But as we move into the second and third decades, the gap begins to yawn wide. By age 65, Sarah's DIY portfolio has grown to $1,816,000. That is a difference of $323,000. Sarah paid more in fees to the mutual fund company than she actually contributed out of her own pocket over her entire career. The convenience of that target date fund cost her more than the total sum of her 40 years of labor. $323,000 is a lot of money. But let's talk about what it actually buys. That is the cost of 5 years of full-time nursing home care. It's the cost of 4 Ivy League college educations for your grandkids. It is the ability to retire at age 60 instead of 65. When you look at it that way, the target date fund tax isn't just a number on a spreadsheet, it's a time tax. You are literally working extra years of your life to pay for a convenience that you can replicate yourself in less than an hour. The financial industry knows that if they make investing sound scary and complicated, you'll keep paying them to hold your hand. But I'm here to tell you that the secret to a 3-fund portfolio is so simple a middle schooler could do it. We're going to break down those 3 funds right now. The 3-fund portfolio is based on a very simple realization. You don't need to find the needle in the haystack. You just need to buy the entire haystack. Most people think investing is about picking the next Apple or Tesla. It isn't. It's about capturing the growth of the entire global economy while paying as little as possible to the gatekeepers. This strategy was popularized by the Bogleheads, a group of investors who follow the low-cost indexing philosophy. By using just 3 funds, you get exposure to virtually every publicly traded company in the world and the entire US bond market. You don't have to worry about which sector is hot or which manager is smart. You own it all. It is the ultimate lazy portfolio, but it outperforms the smart portfolios almost every single time. The 3 components are simple: total US stock, total international stock, and total bond market. Let's look at the first one, which is the engine of your wealth. The first fund is a total US stock market index. This is the heavy lifter. When you buy this fund, you own a piece of everything from the giants like Microsoft and Amazon to the small manufacturing plant in the Midwest. Most people make the mistake of just buying the S&P 500. That's fine, but a total market fund gives you thousands more companies for the same rock-bottom price. These funds are incredibly cheap because there is no manager to pay. A computer just buys the stocks in proportion to their size. If your 401k doesn't have a total market fund, look for an institutional index or S&P 500 fund. The expense ratio should be near 0, usually between 0.01 and 0.04%. This single fund ensures that as long as the American economy grows over the next 40 years, you grow with it. You are no longer betting on a horse, you are betting on the track itself. The second fund is the Total International Stock Market Index. A lot of people skip this because they think US companies are enough. But the US only makes up about 60% of the global stock market. If you ignore international stocks, you are missing out on companies like Nestle, Toyota, and Samsung. More importantly, international stocks don't always move in sync with the US market. When the US is flat, international might be booming. Having this fund acts as an insurance policy against a lost decade in the American economy. It provides true global diversification. Again, you're looking for an index fund here, not an international growth or active overseas fund. Those active international funds are notorious for high fees and poor performance. Stick to the index, keep your costs around 0.1%, and you've officially covered the entire planet's equity market. You are now a global owner. The third and final piece is the total bond market index. If stocks are the engine, bonds are the shock absorbers. When the stock market hits a pothole and drops 20%, which it will do several times in your career, bonds are what keep your portfolio from falling through the floor. They provide stability and a small amount of income. A total bond fund holds government treasuries and high-quality corporate debt. Many young investors think they should skip bonds entirely because they want max growth. While that's an option, having even a small 5 or 10% slice in bonds can prevent you from panic selling when the market gets ugly. The goal of the 3-fund portfolio isn't just to make money, it's to keep you in the game. Now, the big question is, how much of each do you buy? This is where you become the pilot of your own glide path, and the math is actually easier than your 5th grade homework. To build your own glide path, all you need is the 120 minus age rule. Subtract your age from 120. The result is the percentage of your portfolio that should be in stocks. The rest goes into bonds. If you're 30 years old, 120 minus 30 is 90. So, 90% in stocks and 10% in bonds. As you turn 40, you adjust it to 80% stocks. It's that simple. To split your stocks between US and international, a good middle-of-the-road approach is 70% US and 30% international. By using this simple formula, you are doing exactly what the expensive target date fund does, but you're doing it for free. You are stripping out the middleman and keeping that 0.7% fee for yourself. Think of it as paying yourself a few $1,000s an hour for the 20 minutes it takes to update these numbers once a year. The financial industry relies on your inertia. So let's break that inertia right now. Your first action step is to log into your retirement portal and find the net expense ratio for your current target date fund. If it's below 0.15%, you're actually in a good spot. Some companies offer great, low-cost index target date funds from Vanguard or Fidelity. If that's you, honestly, you can stay put. The convenience is worth the tiny fee. But if you see a number like 0.6%, 0.8%, or the dreaded 1.0%, you are bleeding wealth every single day. Look at the other funds available in your plan. You are hunting for keywords like index, total market, or S&P 500. If your plan is terrible and only offers expensive funds, look for a feature called Brokerage Link or a self-directed window. This allows you to bypass the crappy menu and buy whatever you want on the open market. This is your exit ramp from the high-fee highway. The only work you have to do with a 3-fund portfolio is the annual rebalance. Over the course of a year, your stocks might go up and your bonds might stay flat. Suddenly, your 90% stock allocation has drifted to 95%. Your portfolio is now riskier than you intended. To fix this, you just pick one day a year, maybe your birthday or New Year's Day, log in, check the percentages, and sell a bit of what went up to buy what stayed flat. This forces you to do the one thing most investors fail at. It forces you to sell high and buy low. It takes about 15 minutes. If you can spend 15 minutes a year to save $300,000 over your lifetime, that is an hourly rate of $20,000. I don't know about you, but that's the best paying job I've ever heard of. Don't let the fear of complexity stop you from claiming that paycheck.
Why doesn't everyone do this?
Because the financial industry is a master of psychology. They know that if they don't send you a bill, you won't feel the pain. If 401k providers were required by law to mail you a physical invoice every quarter for your expense ratios, the target date fund industry would collapse tomorrow. You would see a bill for $200, then $500, then $1,000 as your balance grows. You would be outraged. But by hiding the fee in the daily price, they've created the illusion of free. They've also spent decades making you feel like you aren't smart enough to manage your own money. They use jargon like alpha and standard deviation to gatekeep the simple truth. Low-cost indexing wins. You don't need an advisor to pick 3 index funds. You just need the courage to admit that the experts in the suits are usually just expensive salespeople. You are the best fiduciary for your own future. Let's bring this home with the 4% rule. This rule says you can safely withdraw 4% of your portfolio every year in retirement. If Sarah retired with her $1.49 million from the target date fund, her annual income is about $60,000. But if she has that extra $300,000 from her DIY 3-fund portfolio, her income jumps to $72,000. That is an extra $12,000 a year. That's $1,000 a month, every month, for the rest of her life. That is the difference between worrying about the price of groceries and taking your family on a cruise every year. It's the difference between a retirement of scarcity and a retirement of abundance. All for the price of 1 hour of work a year. The math of retirement isn't about being a genius, it's about being efficient. It's about plugging the leaks before the boat sets sail. You've just learned how to plug the biggest leak in the American retirement system. At the end of the day, your retirement isn't just a number on a screen. It is your freedom. It is the years you get to spend with your family instead of at a desk. When you allow a mutual fund company to take 1/3 of your wealth in hidden fees, you are giving away years of your life. Escaping the target date fund tax is the first step toward financial sovereignty. It's about realizing that nobody cares more about your money than you do. Audit your 401k this week. Check those expense ratios. If you're being overcharged, make the switch to the 3-fund portfolio. I'd love to hear from you in the comments. What is the expense ratio on your current default fund? Let's start a peer review of these plans and see which companies are actually looking out for their employees. I'm Tom, and this is Tom Talks Money. I'll see you in the next one.